A surprising number of people in the UK could be sitting on more savings than they realise. Recent research shows that up to 36% of adults may have more than £25,000 stashed away. That's potentially around 12 million people with significant cash savings. These funds could come from various life events, maybe a redundancy payout, an early retirement fund, the sale of a second property, or even a small inheritance. Some may have just been diligent savers, preparing for a rainy day or building up a retirement buffer. But while having a strong savings account might seem like a secure position, upcoming changes to the UK's tax system could make it feel more like a liability than a financial cushion. Starting in April 2027, new rules will give HMRC the ability to automatically deduct tax owed on savings interest directly from wages or pension income, all without prior consultation or approval from the individual affected. This development comes with banks being required to collect and share customers' national insurance numbers with HMRC. With this information, tax authorities will be able to see exactly how much interest you've earned and whether it exceeds the personal savings allowance £1,000 for basic rate taxpayers and just £500 for higher rate taxpayers. For additional rate taxpayers, that allowance vanishes entirely. This isn't a new tax, but it's a significant shift in how tax is collected. Instead of waiting for individuals to self-report earnings on their savings, HMRC will now proactively assess the interest reported by banks and take what they believe is owed immediately, and without warning, by adjusting your tax code. If there's a mistake, the burden falls on you to correct it. You'll have to contact HMRC and potentially go through a lengthy appeals process just to reclaim your own money. While HMRC argues that this move will streamline tax collection and reduce the need for individuals to complete self-assessment forms, critics see it as a form of stealth taxation. The process removes any element of control from the taxpayer, placing it entirely in the hands of an administrative system that doesn't have a perfect track record. It's not just about overreach. It's also about scale. In 2021, roughly 650,000 people were paying tax on savings interest. Today, that figure is closer to 2.5 million. A recent Freedom of Information request revealed that HMRC expects this number to reach 3.35 million soon. With interest rates still relatively high, it doesn't take much for savers to breach their personal savings allowance. At a 4% interest rate, having just over £25,000 in savings can put you above the threshold and into tax territory. To give a sense of how impactful this will be, the government anticipates collecting around £6 billion in tax from savers this year alone. With many more people falling into the taxable bracket in the coming years, it's clear this figure is set to rise. At the same time, the government hasn't made a lot of noise about this change. There's been little public discussion, minimal media coverage, and almost no acknowledgement from policymakers, leaving many unaware of what's coming. Behind the scenes, though, there's motivation. The National Institute of Economic and Social Research recently revealed a £50 billion shortfall in public finances. It's no coincidence that HMRC is being handed new tools to tighten tax collection on everyday savings. Banks and pension providers will be required to make what are being described as reasonable efforts to obtain customers' national insurance numbers. But in practice, that could mean aggressive data requests and frequent communications, especially toward those who are older or less digitally savvy. And with this new requirement comes another issue: the risk of scams. Fraudsters are likely to exploit the situation by posing as banks or HMRC, seeking to extract personal details from unsuspecting savers. It's more important than ever to be vigilant and cautious about where and how you share sensitive information. What's also concerning is the potential for these powers to expand in future. If the government can already monitor our savings, adjust our tax codes, and deduct payments without consent, what's next? The more data the tax system integrates from banks, the more automated and potentially less accurate the process becomes. So, what can you do about it? There are several practical steps that can help reduce the impact of these changes on your financial health. One of the most effective is to take full advantage of ISAs. These individual savings accounts allow you to earn interest or investment growth without paying any tax on it. The annual limit currently stands at £20,000 per person, meaning a couple could shield £40,000 in total each year from tax. For those with children, up to £9,000 per year can also be saved tax-free in a junior ISA. Another strategy is to consider increasing pension contributions. You can contribute up to £60,000 gross or 100% of your income, whichever is lower, into a pension each tax year. Contributions are tax-deductible and the funds grow tax-free until retirement. This reduces your taxable income and could help you avoid crossing into a higher tax bracket. It may also be worth reassessing your emergency fund. While it's sensible to keep some cash readily available for unexpected expenses, having a large balance sitting in a regular savings account could now be more of a risk than a reward. Money that isn't needed in the short term might be better invested for long-term growth or moved into tax-efficient vehicles like ISAs or pensions. It's clear these changes are significant. The introduction of automated tax collection on savings interest using your national insurance number and real-time bank data represents one of the most sweeping changes in modern UK personal finance. While it's presented as an administrative improvement, the practical result is a loss of autonomy and a higher burden for savers, especially those unaware of how close they are to the allowance limits. It's important to understand that this isn't a one-time policy. Once this data sharing infrastructure is in place, it opens the door to further changes in the way personal finance is taxed and monitored. What begins with savings interest could potentially extend into other financial products, especially as governments look for new ways to boost revenue without introducing overt new taxes. At the same time, the vast majority of people affected by this won't be high net worth individuals or big investors. It's ordinary people, many of whom have spent years quietly saving, who now find themselves at the center of a growing tax net. So, the key takeaway is to be proactive. Assess how much interest you're earning, understand where your savings sit in relation to the personal savings allowance, and look at whether your money could be better protected or allocated differently. Make full use of tax-free allowances, revisit your financial goals, and consider seeking independent advice if you're unsure how these changes may affect you. This isn't about avoiding tax, it's about managing your money wisely in an environment that's shifting fast. By staying informed and planning ahead, you can keep more of what you've worked hard to earn and protect yourself from being caught off guard by automatic deductions or coding errors. And finally, remember to keep an eye out for any correspondence from your bank or HMRC over the next year or two. These updates may not make headlines, but they will affect your finances directly. The earlier you prepare, the better positioned you'll be when these changes roll out. If you found this video helpful, please like, share, and subscribe to stay updated with more useful content. Your support means a lot. Thank you for watching.